This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello again. So we're going to talk now about the Consolidated Profit and Loss account and other comprehensive income. In our course notes, you can see a pro forma which you could use if you were asked to prepare a whole profit and loss. Again, we know that we won't be asked for that, but it will help to see how things fit together. But you will be asked potentially for certain key numbers from the profit and loss. It could be revenue, it could be admin expenses, it could be the income from the associate, it could be other comprehensive income. And the format that you can see in our notes is probably very close to what you used when you were practicing questions to get through the financial reporting exam. So, as a reminder, generally speaking, you're consolidating the results of the parent and the subsidiary. If the subsidiary has been purchased part way through the year, then we would need to time apportion its results. We might have adjustments that affect revenue and cost of sales identically. So these sorts of adjustments here would be things like intercompany sales. You may have unrealized profits. You may have a fair value adjustment. You don't really need to worry in this exam about columns as such, because you will probably just list down your calculation as opposed to a cross. But the message, remember, is that unrealized profits, if you were ever asked, are adjusted in the books of the seller, and the extra depreciation on fair value adjustments will always affect the subsidiary. Further down the profit and loss, you can see there might be some impairment. If there is some impairment, again, it doesn't matter about the columns, but all of the impairment is shown on the profit and loss, and they'll sort out which bit belongs to the NCI when you do the little extract at the bottom of the profit and loss that says profit attributable to NCI. Reminder that the idea of the group profit and loss is that instead of showing the dividend from subsidiaries and associates, we show their profits. So dividend of income from those companies would not be included. Very important number you can see is the associate number. So you take your share of the associate's profit, and also, of course, you may well be taking your share of the associate's OCI if they've got any. So those two lines very important. So that could be P's share of associates OCI. They're the kind of numbers that we might have to generate. Once the profit and loss and other comprehensive income have been completed, remember that you have to disclose how much of the subsidiary's profit is attributable to NCI. A very common mistake is to take the group profit. It's not. You have to show the amount of the subsidiary's profit that belongs to the NCI, and also the amount of the subsidiary's total comprehensive income that belongs to NCI. If you've not done consolidations for a very long time, you might consider going back, looking at our financial reporting notes, and maybe doing a simple profit and loss to see it all stacked together. But the examples we will look at in these notes are examples which are more reflective of what you would see in the SBR exam. So we'll have a look at an example now of a profit and loss type question, which is in this example here, the one that's called Vada. You can see you've got the numbers down from Vada and Mall, some data about Vada Mall and another company, and the requirement at the end just asking for certain key numbers. Can I recommend, please, that you pause the recording now and spend a couple of minutes looking through that example, and then why not have a go at part A, or maybe A and B, check the recording before you move your way on through the example. So we're going to start by looking at this question. In terms of group structure, again, it's fairly straightforward. Vada has got 80% of MALL, so that's a subsidiary. It's got 25% of SITH, so that's an associate. If you look at the dates, the year end is December 15, so the subsidiary has been owned for 6 months and the associate has been owned for 12 months. So let's just set that up as a little bit of a reminder. This was, again, the example called Vada, or example 4. So I've got a parent, subsidiary, associate. In terms of how long I've owned them, I've owned the subsidiary for 6/12 of the year, and I've owned the associate for 12/12 of the year. Group structure, 80% and 25%. The first number that we're asked for is group revenue. So remember, you consolidate the income and expenses of the parent and the subsidiary, but not the associate, and then you adjust for intercompany transactions. So we're going to have the revenue of the parent, the revenue of the subsidiary, but it's only a subsidiary for 6 months, so it's 6/12 of something. And then we would deduct any intercompany sales, and that would give us our group revenue. So let's look back at the question and see if we can find the numbers. Here we are. I'm just going to highlight in blue now. The parent is 1645 and the subsidiary is 1280. So I'll put those two figures in first. 1645, 6/12 of 1280 would give me 640. Intercompany sales are somewhere further down the scenario. It says there it is. Vada sold goods to MALL for 20 million. It says at fair value. That doesn't make any difference what they've sold. The intercompany sale was 20. That's the thing that we're looking for. So that needs to come out of revenue and also out of purchases, but we're not doing cost of sales here. And that was all after the acquisition. So no time apportioning of that. That's 20. So I think that would give me revenue of 2265. The next thing that we're asked for is, and you'll always be asked for this, is goodwill. So remember, with goodwill, the easiest thing is to pro forma it first. Cost or consideration plus NCI less net assets. And if there is an impairment, that will need to come off as well, less any impairment. So pro forma first, and then try and sort out what the numbers are. So this data will be further down in this scenario. I'll stick with the blue highlighting. So the cost was 90. The NCI was 25. They're using full goodwill. And the net assets were 85. So 90 plus 25 minus 85. So goodwill is 30. Then we just need to hoover around and see if there's any impairment. Yes, there is. It's the first year, isn't it? And it says it's fallen in value by 20%. That's, again, so there has been impairment of 20%. Again, that's not time apportioned or anything like that. Impairment is just something happens as an event. A bit like if you hit your mobile phone with a hammer. But I probably wouldn't do that. Would not be a good plan. So the impairment is 20% of 30. 2 3s are 6. So goodwill is therefore 24. My age. That's just my little joke. There we are. There's goodwill. Let's see what the next requirement is. Group admin expenses. Again, like the revenue, this, isn't it? You've got the parent. You've got the subsidiary, but the subsidiary is only a subsidiary for 6 months, so that will be 6/12 of something. The other thing that you've got is the impairment. These numbers are all expenses, that all debit, so we need to add them together. So let's go back to the scenario. I'll just change highlighting colour to green. Parent is 90 and subsidiary is 50. 90 for the parent and 50 for the subsidiary. So 90, 6/12 of 50, 6/12 of 50 is 25. The impairment is upstairs in the goodwill. So if I look back in the goodwill, the impairment was 6. Debit admin expenses, credit goodwill with 6. So that would give me 121. Now a very common mistake is for people then just to take 80%. You have to add everything together in 100% terms in the profit and loss. So initially you're consolidating all of that impairment charge. Later, when we work out NCI, we'll have to reflect the fact that actually some of that impairment loss relates to the NCI. But notice it's 100% of the impairment charge. Requirement D is OCI, in other words, revaluations. So requirement D, OCI. So it works just like any other line, like admin expenses. We'll have the parent and the sub to think about. So let's find what happened in terms of revaluations. The parent had a revaluation gain of 100. The subsidiary had a revaluation gain of 50. Somewhere in the data, I've just said that the subsidiary's revaluation surplus was at the year end. So I'm kind of making an assumption that that was all post-acquisition. I think you can make alternative assumptions. Personally, if I was marking it and you did 6/12ths, I wouldn't penalise you on that. But I think it's all post-acquisition. That's just the view I've decided to take today. So 90, the impairment, the revaluation. In fact, let me just look back at my printed answer because I might change my mind in a minute. Just give me 1 second. So I did write some notes on. Yeah, in the printed answer, I've done exactly the same. I've pushed it through as 50. But I'm just putting there, assume that's all post-acquisition. But I often see inconsistencies in the way that companies book that, so I can't get too excited, but that's what I'm going to go for. So the OCI, have I put the right number for the parent? I haven't, have I? Good spot. The parent is actually 100, not 90. So I must have distracted myself. So there we are. That's better, isn't it? Oh, it doesn't want to cross itself out. Things always happen in threes, don't they? There we go. So once I fix this, the parent is 100 and the sub is 50. Let's see if we agree on that. 100. Yeah, sub, I've just assumed it was all post-acquisition. What's next? E for Edward is to sort out the share of profit of the associate. So we're going to look now at the share of profit of the associate. And remember, this is the share of the associate's profit for the year. In the P&L section of the P&L of the SPLOCI, we show the share of the associate's profit. In the OCI section, we'd show the share of the associate's OCI. So let's take a look here, see if we can find the data. Here we are. We owned the company for all of the year. Its profits for the year were 100, but we only bring in our share. Just a single line, remember, in the P&L. So the share of profit of the associate would therefore be 25% of 100. 25% of 100 would give me 25. What's left? The last one in these little extracts is the NCI in the subsidiary's profit after tax. So the NCI in the sub's profit after tax. When you used to do these questions, you might remember when you did them in financial reporting, you would type that word attributable to as you split up the group profit after tax. We're just interested in the NCI in S's profit after tax. So a good starting point would be S's profit after tax. S's profit after tax, how much did we consolidate? I'm just going to highlight that number in blue. Here it is. It's 112. But attention, we only consolidated half of it. So S's profit after tax that's been consolidated is 6/12 of 112. 56. Now the only issue is whether there are any adjustments to that figure that would affect the NCI. Because we are using full goodwill, the NCI must suffer their share of the impairment as well. How much was the impairment? We've mentioned it twice, it was 6. So actually, S's profit after tax was 56, less the impairment of 6. I'm keeping everything in 100% terms, so that would give me 50. Then I can take the NCI share. The NCI share back in the group structure was, I think, 20%. So 20% of 50. Good. Sounds like Ben. 10. And there's the NCI in S's profit after tax. So what we've done there is to remind you about the basic profit and loss account. And we've also looked at an example to try and firm in effectively again some of those basic calculations.